Great, thank you so much. And everybody, thank you for joining today. As was mentioned, I'm Jeff DiGiovanni, the CFO of ISNS. Just a little bit of housekeeping or safe harbor statement, everything today, forward looking, but we're going to be fine. Business overview section. I really want to go into who is ISNS and where are we going? So we are a high quality air transport company, everything made in the USA. So we have expertise in systems integration, flight management and monitoring, extensive range aircraft sensors, flight control. ISNS was founded in 1988, and since 2022 through 2024, we have been experiencing significant revenue growth, over 70%. Significant EBITDA growth during that time of over 80%, and then 140 bips increase in EBITDA, and our net leverage is at only at 1.4 times. And why does our customers choose ISNS? Really simple. We're a leader in the avionics market verticals. We have decades of proven experience, high quality, cost effective avionics components, and again, everything is made in the USA. So again, why ISNS? Why customers choose us? We provide advanced retrofit for legacy aircrafts. ISNS provides integrated fleet modernization and retrofit solutions. This provides performance, safety, and efficiency of both commercial and military aircraft. We're able to customize systems and scale them to meet specific needs to all our customers, if that is air transport, air cargo, or business aviation, even the military. We have our dedicated cockpit automation. So really, I'll walk through some of the steps. It's 100% in-house design, testing, and manufacturing. We continue to invest in new products all the time, trying to grow organically and to build the next portfolio generation. In fact, we're about to complete, our extensive 40,000 square foot expansion of our facility in Exton, PA. We possess every discipline in-house. That's through ground up sources such as the availability of components, to engineering, to manufacturing. We design, develop, and manufacture, again, everything in the US right in our Exton facility. And we have a full support and repair capabilities in the facility as well for all our customers. This is a little bit about our products and even the timeline story of ISNS. So back in pre-2000s, we've got into the air data business, really high demand, significant market capture. And then later in the 2001, went into the flat panel displays. This was a standalone, more for the retrofit market. Basically, this kind of helped reduce pilot training, but more importantly, had some aged aircraft to get more safety features in their flight decks for the future and extend the life of those aircrafts. And then we went into systems integration, and now we're going into the next gen, which is expanding the display and control applications into other areas of strength. Over the last 2 years, ISNS has been growing inorganically through acquisitions. And back in June of 2023, the company did their first acquisition ever. And that acquisition was a product line acquired from Honeywell, and it was the audio management units, radio management units, and transponders and inertial reference units. This acquisition was around $40 million costs, and today it generates a little north of $10 million on an annual basis. And this supports Boeing 737, 747, 757, 767, Airbus, Gulfstream, and Citation. The next acquisition we did was the most recent one, was September of 2024, and this one was with Honeywell as well. This was about a $15 million acquisition on the digital flight control computers around the F-16 platform. And under this acquisition, we brought on a backlog of a little over $80 million on our books. So we've been working with both Lockheed and Honeywell in the transition of this, but this supports the F-16 fighter jets that are out there today. And there's going to be a lot of opportunities even with the US Air Force for upgrades. As you can see, how many units are in Chile, Portugal, and all around the various parts of the world. Our expertise in this is really simply manufacturing the product, more cost effective for government programs, and really got us in front of the military for the digital flight control computers now from an ISS perspective. So over those couple acquisitions, we deployed about north of $50 million in capital, and today we have about a little less than $27 million of debt. So we've been paying down our debt on an aggressive pace. The track record, this is really something I kind of really like looking at. So when you look at 2022, we started at $27 million in revenue, and last year we're a fiscal September year end. In 2024, we had about $47 million in revenue. Our adjusted EBITDA went from 7.6 million to 13.7 million. And our EBITDA margin expansion went from 27.6% to 29%. Again, just over those couple periods. And free cash flow was relatively flat, I would say, from 2022 to 2024. More importantly, because we're putting resources back in the business to grow in terms of technology, people, and even on our facility. As I mentioned, we did a 40,000 square foot addition for about $6 million, which should be completed in the next month or so. So why we say ISNS? We have targeted commercial expansion. We're developing new products with our engineers on a daily basis, cross-selling synergies, and we're trying to win all new programs. We have expanded our military platform and our business. Most recently, we're getting to become a secure facility from a DoD perspective, so we could go after those larger military contracts. And we're opportunistic in terms of what's happening with DOGE and currently the efforts in the government, where they may be cutting some military programs, but this allows companies such as ISNS to really kind of work with the government to spread those dollars further by being more of a scalable and a creative solution for advanced avionics products at a very reasonable, cost-effective price with high quality and high safety features. And then again, we're always looking to discipline capital allocation. We're investing in new product line acquisitions, always looking for acquisitions to expand our portfolio and really maintain that financial flexibility. Why does an investment in ISS make sense? We are advanced avionics specialists, offer technical domain experience. We have long-term OEM and retrofit contracts, long-term contracts for recurring revenue streams. As I mentioned, our backlog even today is at $80 million. Probably about 2 years ago, that backlog was about $12 million, $12 million. So in the last couple of years through acquisitions, we now generated a backlog of $80 million for the next couple of years. And we have favorable secular tailwinds. As this aircraft ages, there's opportunities for retrofits, upgrades, and also autonomy flight. And what I mean by that is on a Part 25 aircraft, which is a Boeing 737 or Airbus A320, there's 2 pilots. There is technology out there that we are working on that you can eliminate the second pilot through an advanced checklist and an automated process. We are probably in our lifetime, we'll see a reduced pilot in the cockpit. Now, this will be driven by Boeing, Airbus, and those factors in Honeywell. But what happens with all the fleet that's out there today to have retrofit? And that's where an ISNS will come into play to try to retrofit a lot of that market in the next couple of years. Once this technology is out there in these aircrafts, which it's going to happen in the future, just, in the next couple of years, we'll probably see more where that's going to go. And then ISNS Next it's our new philosophy to provide clear, measurable financial targets around value creation. And we talk at that on every earnings call now. So overall, here was our performance for Q2, which again, this is very exciting because now you're really seeing the impact that we're doing with these acquisitions. More importantly, revenue growth we had of 104% in the second quarter. It was mainly driven by the F-16 platform from Honeywell and our air transport market. But our net income rose to 30 cents per diluted share, up from 7 cents a year ago. And our adjusted EBITDA went from $7.7 million up 219%. And our adjusted EBITDA margin was at 35.2%. And this really highlights the scalability we can do with acquisitions as one of our main strategic goals in the future. And some of the milestones we're looking at that we accomplished was investments in our infrastructure and systems to support our defense customers. Again, this is where I mentioned about our DoD security clearances. So now we can go get those bigger contracts. And even with somebody like Doge out there trying to cut programs, this allows us as a smaller business to work with these government authorities to spread their dollar out and get those programs more cost effective in the future at a high quality, high reliable product. And again, as I mentioned before, we have a set of engineers that we can tailor fit the needs of our customers. And we're looking at continued progress on the Honeywell integration. The F-16 platform should be coming in late summer under our headquarters. And most recently, we also completed an ERP system integration. The company historically was on a legacy platform that was hard to use and not as efficient. We went to a NetSuite platform, so now we can develop KPIs, really run the business, and get actionable data to drive growth in the business. So again, Q2 2024, we had $10.7 million in revenue, and then Q2 of 2025, we did $21.9 million in revenue, and our adjusted EBITDA growth was $2.4 million to $7.7 million, and our EBITDA margin was 35.2%, which really reflects the operating leverage that we have in this business today. And our backlog, as I mentioned, back in 2024, Q2, it was at $10.4 million, and at Q2 2025, we're at about $80 million. Cash and availability, our cash on our balance sheet, we sweep to pay our debt. So our net leverage, you can see, went from about 1 times, then it trickled up, and that's really for the acquisition timings, and now it's coming down to 1.4. So Q1 was higher and Q4 because of the acquisitions we did, and now it's starting to tail off a little bit to 1.4 times. Again, we still have a lot of capabilities to do further acquisitions and to grow the company. And this is just a reconciliation. We could put this on our website, but with that, I'll turn that back over to the moderator for any questions.
Okay, thanks, Jeff. If you do have some questions, you could please ask it in the questions section of the GoToWebinar panel. I'll start off with some of our own, and then maybe we can get into some questions. So can you talk about the magnitude of the Honeywell product line pull forward and guidance stability?
Sure. So that product line of Honeywell on the F-16, that whole entire back order is really late. So those deliveries were already past due from Honeywell and Lockheed. A lot of it was from supply chain issues and some obsolescence redesign that had to be done that was most recently completed. So, you know, when we say pull forward, it's really mostly just shipments that went out faster than normal. So we were projecting probably around $5 million, and probably about $7 million went out on a go-forward basis. And that could change quarter over quarter, and that's why it's hard to really predict what that next quarter is going to look like, because we're working with Honeywell and Lockheed on the timing of those deliveries. So again, when you look at a true pull forward, it's mostly taking revenue from forward quarter back, and this is not the case because it's all past due. It's just a matter of there was a little acceleration in terms of the timing of what was produced, about $2 million.
Can you talk about your ERP system productivity and SG&A trends? Where do we see SG&A in the quarterly range going forward?
Yeah, so I think you're still going to see some investments in SG&A, right? You're always trying to attract top talent and get good quality people in terms of what the ERP system does. So when you do your accounting close and your processes, if you don't have a really advanced ERP system, a lot of that is time consuming and manual process. A new ERP system will allow more technology and a quicker results to drive actionable data on a daily basis so the business units can make strategic decisions in terms of labor forecasting, utilization of labor, as well as scheduling overtime and workloads. So I would see as we scale the business that operating leverage in SG&A will continue to, I would say, go down, and you'll have higher operating leverage in terms of your SG&A.
Can you talk about the M&A landscape? What does it look like, and um, how many acquisitions do you hope to do in 2025 and next year?
So the M&A market, it's still, we're looking at deals all the time. We're looking at product lines versus small businesses. A lot of it's timing on what's coming from the big guys, such as like a Honeywell or something like that, that would divest, that we're interested in. We're mostly interested around the high value targets on the flight deck. That's our sweet spot, and we want to stay in that range. So we're expecting, hopefully, in the next 18 months to still do, more acquisitions. My hope is to do 1 or 2 acquisitions in the future, but that's all dependent on what's coming out that we feel that fits the ISSC platforms. So it's really a matter of what's going to be coming out I would say, in the aerospace industry in the next few months that we would see more activity.
Can you compare and contrast margins and segment revenue between commercial and defense business?
So yeah, I mean, we don't look at, we operate in one segment. We don't split out the segments in the financials or, from an SEC standpoint. So when you look at it, they're all blended, but military typically is a lower margin than commercial. So historically, when you had the historical books and records of the company, they were doing mostly with business aviation and commercial air transport. So those margins were thicker. But military wise, because there's very prescriptive policies that you must file as a provider to the government, it's fixed firm priced or cost plus margin. So those margins are a lot lower. So your margins are probably around 20% for those kind of programs, but they add different costs in there, some engineering recovery and things like that. So we expect to see our margins lowered because of the product mix of military is high. And that's where you see the margins from historical was probably around 60%. And then this last year was trending in the mid 40s. So that's where we're targeting our margins to be on a go forward basis, is around the mid 40s. And we're really trying to get everybody to focus on our EBITDA margin, because that takes into account, all the products, and that's where we're right around about the 30% EBITDA margin.
Do you see any opportunities from DOGE?
Yes, as I mentioned, when you look at DOGE, what they're doing, right, wrong, or indifferent, they're cutting costs. Hopefully it works out. And some of the programs that they'll cut, it's not bad for ISSC. I think it could be a good thing because, again, we develop high quality, reliable products in the aviation space. So we can spread those dollars further for the government. And working with an ISSC versus one of the big players, again, our cost structure is so much different. So we could provide a good quality, high product to them at a lower cost. So when you look to try to fill out those programs, ISSC could be a good solution for some of these programs that are coming up that you want to kind of shave off some of the dollars from those governmental programs. So I'm opportunistic that this will actually help ISSC in the future.
Okay, thanks for that, Jeff. That concludes the question, or there's one that came in. How are your toughest competitors, and what keeps you up at night?
So our competitors, we always say, our competitors are the big guys, Lockheed, Boeing. Really what keeps me up at night, I would say as a CFO keeps me up at night is a couple of things. One, what's happening with the tariffs, right? In the market, because every day there's something new coming out with tariffs. And if you just look at Twitter, you could probably find out what's today's tariff debacle. So with that unknown in the market, there's a lot of volatility in the stock. And being a public company, you always have that volatility. But when you're looking to do transactions and raise money, it affects it. So that's one component. How's those tariffs really going to impact the future, not only for just aerospace, but overall from a consumer perspective, because consumers are probably we're going to feel the impact of tariffs. And the other piece is also just making sure you have the right talent. It's always hard to get good talent and keep good talent. So one thing always keeps me in making sure that we have the right talent in place, which we do, but always making sure that, they're happy and we don't lose them to some of our competitors.
Okay, great. Thanks. That concludes the question and answer session. Do you have any final closing remarks?
I appreciate everybody's time taken today. And if there's any questions, please go on our website, reach out. There's the investor relations phone number, get in touch with us, and we could have separate dialogues.
Sounds good. Thanks for that. We'll take a short break and be back at 10 a.m. Pacific time. So see you then.